Welcome into the reaction channel, folks. I hope everybody's doing absolutely phenomenal out there as always. We have some big developments going on out there. My number one biggest investment personally is a company named Meta. They are making some monumental moves here. We're going to talk about what that means for this company, what that means for the stock price for the remainder of this year, what it means for future years, all that good stuff. Then I want to go ahead and react to this little clip here from Goldman Sachs, David Kostin, on where he sees the markets headed, and he definitely sees them going higher. Looking forward to reacting to this one. Mike Wilson, who was everybody's favorite bear a few years ago, Mike Wilson on stocks, market headwinds in the Trump tax bill. Looking forward to reacting to that one. The bear traps Larry McDonald on his 30-30-30-10 portfolio. I'm looking forward to reacting to that one, sharing my opinions and perspectives on what about constructing a portfolio 30-30-10. Looking forward to sharing my opinions on that. And the last one up here, JPM recommends selling Tesla. Here's a breakdown of the call, so looking forward to reacting to that. One thing only I need from you guys for this action-packed video: smash that thumbs up button. That's all I need from you guys. I hope you appreciate me doing these videos. Look at Elf on a Shelf. You know, I'll be flipping my flapjacks. This baby's up a shocking 138% from the lows it hit back just a couple months ago, back in April, right? Unbelievable. But yeah, we obviously have a lot of stocks coming back. A lot of these stocks still have a long runway ahead, so do keep that in mind. You know, look at AMD 123. I was speaking about AMD on the main channel last night, talking about how that one, you know, if we can really get momentum going there and Thursday goes really well, don't be surprised if that stock hits $200 at some point this year. I'm not talking about in future years, I'm talking in this year. And so yeah, a lot of exciting stuff. All I need from you guys: smash that thumbs up button and make sure you're subscribed here to the channel. Also, congrats to the members of my private stock group. We just had 11 people last week hit the six-figure mark. So they have joined the six-figure club, and then we had 5 people make it to the 7-figure club last week. So big week. We sent out those awards yesterday morning. So congrats to all you guys. If you're looking to apply, join my private stock group, my private wealth group, get access to the entire Discord chat, access at 1000xstocks.com. If you're looking to get access to all my course curriculums, teaching you everything I got up here that I've learned in this market over the past 16 plus years, and take your game up to a much higher level. Stop gambling money. Start being confident with your investments. Click the pinned comment down there, fill out a form. We'll see if we can get you access to all that and get you up to a much higher level, okay? Alrighty, let's get into this.
Bloomberg says that the Meta CEO has been frustrated with his company's progress in the AI race so far and is putting together what's being called a super intelligence group inside Meta. The report says that Zuckerberg's goal is to beat other tech companies to reaching the...
See, you know what? This is so big. This is so big. Listen. That's a difference between somebody that really pushes a company hard versus CEOs that are just there to collect a paycheck, right? Because you're looking at Meta. Meta is doing amazing things in AI, and they're already making fortunes of money from AI. Like, if you want to talk about who's making the most money in the world from AI, honestly, outside of NVIDIA, the company making the most direct money from AI is Meta, through their AI algorithms that they already have running on Facebook, Instagram, to feed content, to run ads, all that good stuff. And yet, even with all this success, right? Even with the Llama model, Zuckerberg still say, we're not moving fast enough, we got to move even faster. That's big, man. You know, that's what true top CEOs that are dedicated to their companies, that's what they do, right? And what would Steve Jobs do? Exactly what Zuckerberg's doing, right? Like, he would move that company faster and faster and faster. And when you have a CEO that is there day in and day out, right, pushing his company, it leads to phenomenal results over time versus, you know, some of these CEOs that, you know, are kind of, you know, work at their companies 2 days a week, right? You know, some of those guys, you know.
Where AI can perform as well as humans do so that it can incorporate the technology into its range of products. According to reports over the last few days, Meta is in talks to invest billions of dollars in an AI startup, Scale AI. Bloomberg says that Zuckerberg is personally working to recruit dozens of people for Meta's new effort, driven by frustration over the response to the latest version of the company's Llama large language model. It's very similar to what we've heard from Sergey Brin, getting kind of reinvigorated by this a couple of years ago, actually, and building up and spending a lot, running that team himself. AI is definitely the thing that has all these original coders super excited, super competitive about, and Zuckerberg's apparently moving desks in the office so that all of these people can sit right by him.
Well, hurry up. It'll be interesting to see. It seems quantum. Like you made that quantum leap, and now we're really moving quickly. We'll see. It's amazing now. I am impressed at times with when I ask something.
Yeah.
Like, wow, how does that work?
So, 100%. That's why I feel very comfortable having $1.1 million plus invested into Meta stock. Of course, $931,000 of that is gains in the public account, right? But that's why I feel very, very comfortable. Because you got a man there, Zuckerberg, he's like, hey, we're going to move desks. I'm moving desks together. Like, we're going to do whatever it takes to make this certain thing happen, right? And I posted this on my X page. If you guys ever want to follow me on X, it's always linked in the description area down there if you even use X. But, I post quite a bit of stuff on there almost every single day. Like you can see in the past 24 hours, I've made like several different posts on different things, talking about many different stocks. But this one I thought was really important. I just posted. I said, $1.1 million plus I have invested in Meta. What many don't realize is Meta is the number 2 most direct AI play in the world outside of NVIDIA. They're even more AI than Palantir, which is saying a lot. Investors realize how much of an AI company Meta is over the next 3 years. And when we're talking about Meta for AI, we're talking about how it feeds you content through their platforms, right? We're talking about what types of ads it serves up to you, because at the end of the day, if Meta is going to get advertisers to spend more and more money, those advertisers have to get better and better ROIs. If the advertisers get better ROIs, they can spend even more money with Meta, and it's like a great cycle. Plus, if people actually get ads on those platforms that they're actually interested in, right, it's a better consumer experience as well. Everybody appreciates that, right? So it's a win-win across the board. But then we talk about what they're doing with the llama models. Then we talk about all these subset of features they're going to have on their platforms over the coming years, right? And what they're going to be doing there. I mean, and you talk about, let's say you're a top software engineer in the world, right? A top coder. Who do you want to go work for? You want to go work for Apple, that's having trouble doing anything. You want to go work at Microsoft, fall asleep. You want to go work at, OpenAI. You want to go work at Meta, where you might be one of those 50 desks working alongside Zuckerberg, right, on a day in, day out basis. Or you want to go work at Tesla, where, you might see the CEO once a year. Where you want to go work? I want to go work at Meta. And so, I think that's very meaningful, because at the end of the day, these companies with the best workforces are the ones that push the fastest and make the most insane new products and services that people are like, dang, like, how did they just come out with that? Like, how did they just create that out of thin air, right? And so Meta's moving fast here. Zuckerberg's not content for even a second. And I love that, man. I absolutely love that, because there's a lot of these big tech companies get really complacent, really content really fast here, right? Alrighty, next one up here, David Costin on where the markets are headed.
Who joins us here on set. David, good to see you. Welcome.
Good morning. I see you.
Are you sensing a legitimate reason for the market to grind higher?
Well, near term, there is some concern about the tariff uncertainty, but people are generally optimistic on the prospect that that's going to be resolved in a positive way. And so longer term, our expectation is the market rises maybe 9% or so, high single digit, maybe 10% when you include dividends over the next year. But near term, there's some uncertainty, and not surprising, the market has rebounded pretty significantly off of its low in early April.
Are you looking for the hard data to start to reflect the weak soft data of the last month or two?
Well, the equity market traditionally trades more on the soft data than on the hard data. And the expectation is that we've had a weak bout of soft data. Maybe some of that may be turning. So I referenced the small business optimism as an example, so the surveys. But the hard data is expected to weaken in the next, our economics team is expecting that to be weak in the next sort of month or so. If we sit here today in the mid part of June, you look out over the next sort of month to 2 months, we still have some uncertainty on that extension of the tariff. That delayed implementation goes through the early part of July. You have earnings season, which will start July 11th through our first week of August. So that's uncertainty exactly.
Before it goes further here, what do I think about his call here for the market to go up 9% over the next year? Well, what a boring call. And why do I say that? And the reason I say that is, how much do you expect the S&P 500 to go up per year? Usually around 8% or so. So by saying he thinks the market's going to go up 9% over the next year, It's basically saying the market's going to do what the market does on average. Like, that's not like a big bold call or something like that, right? And so, I'm expecting seeing this market continue to grind higher. And if this market continues to grind higher, throughout June into July, August, I think there's going to be fireworks this fall. I think there's going to be fireworks. I'm still trying to figure out exactly what's going to be the lighter in this situation, but I'm expecting fireworks this fall if the market continues to grind higher. This just is a little too good to be true, right? Like, we got fireworks coming. It reminds me 2018.
Pricing actions would be in the companies in terms of their ability to maintain margins. The China delay in the tariffs, 90 days, that'll put you into early part of August. So we're sitting here in the next month to 2 months. You get some hard data will be weaker. You get some uncertainty around the earnings. The blackout period for company share repurchases basically ends later this week or early part of next week in terms of the month before season when company.
Something important you got to understand here is if the market does see a little weaker hard data, as long as it's not like off a cliff, the market will gladly take a little weaker hard data. Why? Well, that helps alleviate the fear around overheating economy or fears around inflation, those sorts of things. And so the market could get more confident in Fed rate cuts. Because if you get some more weakening hard data, the Fed can say, you know what, we need a cut. We need to start cutting. We need to start another cut cycle, right?
Are able to still repurchase discretionarily their shares. So these are some of the variables, the signposts we're looking at, clients are looking at. To look out further to next year, the economy is likely to continue to grow. We don't have a recession in the forecast. That's not the base case. And therefore, you've got earnings growth, 7% this year, another 7% next year. That lifts the market to around 6,500. 6,500 is roughly up nearly 10%. That's kind of the framework as we talk about it with clients.
So where do you think tariff rate? We're kind of under a month here into the 90-day deadline to make a bunch of trade deals, and we haven't seen much on that front, the UK. So how do you factor in what that's going to do to margins?
So when we think about it from a level perspective, the margins, effective margins in the United States averaged around 3% last year, and our economics team is modeling in something around 16% this year, well, really into once those get implemented, probably 16%, about a 13%
effective tariff
increase.
Rate.
That's the effective tariff rate. So what do you do as a fund manager? One of the things we talk about with clients is around companies that have been able to generate high and stable gross margins. And so the idea, Sarah, would be those companies who have demonstrated over the past decade their ability to maintain those high margins. So you look at some of the companies, Kroger is an example of a company who's done that. You could look at GE Vernova. You can think about companies like Salesforce, IBM. These are companies that have demonstrated high and stable gross margins over a period of time, and we think that's a best indication of companies' ability to maintain their margins. Because right now, that is the central debate as to all these tariffs, if and when they may get implemented. How are they going to be? Who's going to pay for them? Is it going to be the...
So, there's... I think it's way too early to say there's not going to be a recession next year. Way too early. A couple things to keep in mind here. Okay, listen. First, home building. Home building drives so much of the economy. How do the home builder numbers look as this year goes along, right? You need to see these companies continue to sell lots and lots of new homes so we can keep that construction market going, because that just creates so many jobs in so many adjacent industries as well. So I think that's really important. Let's keep an eye on that. If these home builder numbers really start to weaken considerably as the year ticks on, I would worry about recession a lot more for next year. Obviously, you guys have seen the images and you've seen everything that's going on with the ICE crackdowns, right? You might think, it doesn't have anything to do with the economy. It could end up actually, I was doing some thinking about this recently. I was like, dang, this could actually negatively affect the economy. How? Everybody knows there's a massive amount of illegals living in the United States, right? Those illegals spend a lot of money. A lot of money in the economy. They work their jobs and then they go spend that money, right? If you are in this country and your papers aren't right, are you going to go out and spend any money for the next however much time, whether that means months or years to go in the future? No, you're going to probably just try to do whatever your job is, go straight home and stay in the dang house, because you don't want to even risk going out right now, right? You don't want to risk any sort of situation where you could be pulled over or anything, because then you could be talking about, your whole family's going to be uprooted. And so you got to understand there's a lot of the spend in the economy is people that don't have their papers right. And those people are really, really, really going to have to, are going to be scared to go out for a while. Like imagine you being in a situation where your papers aren't right. And you're seeing all this stuff every time you go on X, every time you go on Instagram, TikTok, whatever, right? About people left and right, being put into one of those ICE vehicles. Would you say, yeah, I'm going to go out to the mall right now. I'm going to go out and do this. I'm going to go to the taco shop. I'm going to go here. I'm going to go there. I'm going to go to the restaurant. I don't know, man. I'd be hunkered down. That's all I'll say about that, right? And I would be a little petrified to even go out and spend money in the economy. And so, I think it's too early. It's too early to make a call that the economy is not going to have a recession or will have a recession in 2026. But those are two factors. Pay attention to home building. And I think this whole immigration situation, I don't know how that's going to shake out, but I don't see it being a good thing when it comes to the economic front in the short term. That's for sure.
Is it going to be the companies going to absorb that? Is it going to be the ultimate consumer? And that is a subject of some debate. Different companies, of course, have different leverage and power in terms of pricing perspective.
I mean, I just keep highlighting retail because traditionally you would pass it on to the consumer, but this is not a consumer environment for a lot of retailers where they can do that.
So when our conversations, and I spend a good amount of my time with corporate managements, is a question about whether the consumer will trade down from a branded product to a private label product. That's a way of having a product substitution, not having to pay the premium, if you will, on the tariffs. And so you get a similar product at a same price, basically, as you had before. That would be one behavioral response to the tariffs, as an example on the retail side. And we hear that from some of the larger producers right now.
And another factor in regards to the whole immigration situation, right, and this ties back into home building, is we got to be honest here. A lot of the home building industry hires illegals, right? The question is, how much of a percent does that home building industry, how much of it are people that don't have their papers right? Are we talking it's like 5%, 10%, 20%, 30%? I've seen estimates before that are kind of in the 15 to 20% range. We don't know, but it's a big number. It's not a small number. So, if we're talking about the home building industry had to go only people that are for sure 100% U.S. citizens, I mean, it's going to get a lot more expensive to build homes. A lot more expensive, right? So, just something to keep in mind there, which then weighs on inflation, right? And makes for more inflation. So just all things to keep in mind here, right? And the construction industry in general, trust me. Wilson on stocks, market headwinds in the Trump tax bill.
Very noisy and uncertain. And I think, this has been the case for the whole year. Our view, as you know, has been a bit different. We came in thinking the first half would be tougher and the rate of change on a lot of things like earnings revisions and some of the headline would be negative. And in fact, that what we think happens, that all got priced in the week after Liberation Day, right? It was violent. It was a deleveraging. And so now, as we look at the data itself, it's all inflected higher. And so, don't ignore everything, but ignoring the headlines is probably a good strategy and just focus on the data has turned up for the most part. And I think, I don't know where the trade negotiations are going. Nobody does. Sure. But I think it's very unlikely we're going to go back to where we were, a month and a half ago. Like we bottomed in terms of the pain of that initial, announcement and how bad those tariffs were. So unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
What the bear view sounds like? They would say that maybe some of the data, some of the earnings we've seen have been flattered by pull forward, and we'll get the bill for that later this summer. Do you think we're priced for that kind of slowdown, that weakness we could see in the summer months?
That's probably right, and we had that view too. There was a pull forward in Q1. Q1 ended up being better than they feared because, the numbers came down a bunch. I think the second quarter, though, is expected now to be weaker. So that's going to be the key. I think the biggest risk for the market is going to probably be either rates, as we've talked about in the past, north of 4.5%, or we do go into earnings season. It's not as good as, people were hoping for, and we have maybe a 5 to 7% correction. But that's not what people kind of want. People want another 10 to 15% drawdown to get, better, to get more exposure. And I just don't think you're going to get that. I mean, I've seen this a million times. You want it, but you're just going to have a shorter trigger finger.
Well, you had seen retail largely buying the dip. That's who participated when you got those ruptures in April. If we're not going to get dips like that anymore, what is the willingness of institutions to continue to put money to work right now, especially they didn't even buy the past dips we saw?
Yeah, I think institutions have re-risked, but there's still more to go. The area that I think that you have to watch is the systematic strategies, the CTAs, that price momentum money. We saw almost $500 billion of deleveraging in that period of sort of early March through mid-April. And they've re-risked maybe 30-40% of that. So that's another bid that's sort of, it's not fundamentally driven. It's just price momentum. So that's going to be kind of the underlying bid. And then I think, most institutions have re-risked. But one thing I haven't talked about yet is people are still making the quality bet. And we agree with that, meaning this isn't the beginning of a new cycle. It's once again an extension of the existing cycle. And the Fed's probably going to be cutting at some point later this year, early next year. And that really behooves the large cap quality equities.
Does it behoove companies specifically who can also wait out some of the tariff uncertainty? Because this had been a big part of the narrative, right? No one's making decisions. CapEx is largely stalled unless you're tech. Is there an element where even though we don't have tariffs resolved, that you get companies who just get on with it and start to put capital to work? Yeah, they got to run a business. And that's another reason why large cap quality businesses can do this. They can mitigate some of these, risks, whether it's tariffs, whether it's, maybe the government cutting back on certain types of spending. And one of the things that is getting through this tax bill that I think is still underappreciated is the tax incentives for CapEx and R&D spending. We think that could add 3 to 5% to earnings growth or cash earnings for these large multinationals. That's a big tailwind in addition to the weaker dollar. So there's just a lot of tailwinds I see from an earnings standpoint. And this is almost a perfect environment to climb the wall of worry because the economic data, the political, geopolitical data is messy, it's noisy, it's scary sometimes. But as long as the revision factors for earnings are heading north, it's just hard for stocks to go down. When you say CapEx, I just think of a handful of tech companies. Do you think it goes beyond just tech leadership? Oh, absolutely. I think this is about capital goods. I think this is not just about AI CapEx. Also, one thing to just keep in mind, the IT CapEx that's been good the last several years has really been concentrated just in AI. Okay, the traditional kind of upgrades you see in the enterprise and in the household have not been happening because there was a giant pull forward, remember, in 2020 and 2021 for work from home. Fair. So if you actually look at the IT CapEx cycle from 22 to 24, it was kind of a soft recession. And that's another part of our thesis. We've been going through these rolling recessions. And look, to me, the big catalyst to keep in mind for a broadening out is going to be when the Fed starts to signal they're more dovish. I don't know when that's going to be, but my guess is sometime in the third quarter, they're going to start to signal that. And that's when you're going to get a more broadening out to the lower quality parts of the market. Does the why matter? Do we need it because inflation is coming in? Or is it going to be because the labor market is cracking? Well, I mean, look, last fall, it was both, right? I mean, the labor market was cracking last summer. As soon as they signaled they were ready to step in, the market went up anyway. So that's why, I mean, I actually think a recession, if we finally get the, broad recession labor cycle, I don't think the equity markets are going anywhere near the April lows because the Fed will be able to act quickly. And we're like Pavlovian, right? And if retail is buying when the Fed wasn't even cutting, if they are cutting, there's going to be a big bid there. So look, there's always risks in the market. There's always something to be worried about. There's always things to be bearish on, and there's things to be bullish on. And that's our job. And I think, this year we've navigated that pretty well, being in the right places. And I think we're going to continue to have to shift what we want to own, not so much how much you want to own.
So to push back against his points there, when we talk about the Fed going to their next cut cycle, there's two risks that come along with that everybody has to understand here, okay? One, when the Fed signals they're about to do another cut cycle, some people could look at that and they say, oh boy, we're going into recession. That's why they're cutting, right? Now, that could be true. That could be false. We don't know. But the moral of the story is there's definitely a lot of worries that happen when the Fed starts to cut like that. And people start saying, you know what? Like recession. And then people start saying, how big's a recession going to be, right? Because you don't know. Like a recession could last a few quarters. A recession could last a whole year. A recession could last 2 years. So you don't know how far, how deep. You don't know how high unemployment rate. You don't know any of that. It's just a scary time whenever you're going in because you're like, crap, we don't know. Like it's going on a roller coaster ride and you don't know where the bottom is. Second risk here that we already witnessed this again, what was that last year, is if the Fed starts cutting, you could, hopefully we don't see this, but you could see the 10-year spike again, right? And you could see bonds in general spike because they're worried about longer run inflation expectations. If that happens, that could be a scary moment for the stock market for sure. If all of a sudden that 10-year starts popping again, and all the bonds in general, all the treasuries in general start popping, so, that's just something to kind of keep in mind in regards to the whole, it's not just only good outcomes if the Fed enters their next cut cycle here in the next few months. It, could be some scary that comes along with that.
Acknowledge the one thing that could be a headwind for equities is interest rates. You wrote about it over the weekend. What is it about 450 that's challenging to this equity market? Because based on the rally we've seen over the past few weeks, we don't see much of a challenge.
Well, it's stabilized at 450. So we've identified this level like almost 2 years ago, and it's been like a charm. I mean, as soon as you cross 450 on the upside, the correlation between stocks and rates goes negative, and vice versa. Now, I do think that we kind of went to 470 in the April period, and then they calmed down again. I think the market is getting comfortable that they have enough tools, because the Treasury Secretary has talked about that, to keep it 450 or below if they need to. And I think we talked about this last time I was here. 475 is like the worst place, because that's where markets get really nervous. 5%, I actually get bullish, because then I know that they're going to come in and intervene with either liquidity injections or they're going to use these other tools that the Treasury Secretary has talked about. So we're optimistic that could be managed. And in other words, that risk could be a risk for 5 or 7%, but ultimately that risk will get managed too.
Do you get clients asking you now about the debt auctions? Asking the equity strategist about the debt auctions that take place in the week?
Well, I don't really ask the equity folks, but people do ask about it for sure. And once again, we have seen many auctions, soft auctions for the last 2 or 3 years. We've seen this occur, and then they get control of it again. I don't want to dismiss the risk from the back end of the market. That is still, to me, the risk. It's the risk not only for markets, it's a risk for the U.S. Like we have too much debt, and this is a focus. And if we don't, ultimately, if we don't, cut the budget over time, and maybe the market is now giving them a lead, okay, we'll give you 12 months, but if we don't get serious about, budget reconciliation and actually reducing the size of the budget over time, this is an issue that's going to stay with us.
Yeah, no, when it comes to the tax cuts and all of that, right, which hopefully that bill, is finished off rather soon, but it's important for everybody to understand when it comes to the tax cuts and all that, right, when does that really start to positively affect the consumer, positively start to affect the business cycle and all those things? The answer is it doesn't even start to until, let's call it 2026. But that's like the start. The real effects positively will be in 2027. Okay, in terms of when it really trickles down to the consumer, and then maybe people start getting big refunds and things like that because they paid in too much during 2026 because they were focused on past tax rates and those sorts of things. So you're going to get some positive effect in 26, but you'll just get much more positive effect in 2027, 2028, and however long those are in for. And so just keep that in mind. If you think like that's going to get passed and right away it's going to mean like great things for the economy, no. It's going to take time because you have to have a whole tax cycle to get into that. Okay, so just something to keep in mind there. Alrighty, next one up here, the bear traps. Larry McDonald on his 30-30-30-10 portfolio.
99. You've also got precious metals that have been climbing. You know about gold. We've been watching that for a while. It's up significantly this year. Silver at this point is at its highest level since February of 2012. Our next guest says that gold and other precious metals have been warning investors of what he calls a creeping financial repression and that a bond market panic could be looming. Joining us right now to explain all of this is Larry McDonald. He is the founder of the Bear Traps Report. He's also the author of the new book, How to Listen When Markets...
Was my guy a human? Look at him.
A creeping financial repression and that a bond market panic could be looming.
Say creepy?
Joining us right now to explain all of this is Larry McDonald. He is the founder of the Bear Traps Report. He's also the author of the new...
Was he human or was he mannequin? What in the world?
How to Listen When Markets Speak. And Larry, thanks for coming in this morning.
Thank you, Becky. Thank you, Joe.
So Jamie Dimon was speaking in the last week or so, maybe 2 weeks ago, and saying that we could be facing a bond market revolt that could come in 6 months. It could come in 6 years. He doesn't know, but he knows what he's seeing on the fiscal side of things does not add up to nirvana for the bond markets. Why do you think it's sooner?
Well,
rather than later?
So what we try to do at the Bear Trap Support is measure the life of a narrative. So we talk to all our institutional clients around the world and kind of triangulate the information. And if you look at it, so right now the debt ceiling, we're stuck. So for every bond that comes due, one matures, and there's no new net issuance. But from September 1st to maybe, let's say, February, we're looking at 1.5 trillion of new issuance, of new debt issuance, and it comes out to roughly, could be up to 600 billion more than last year. Now, to me, the market knows this, the smart money. We just hosted an ideas dinner last night, and when you talk to institutional investors, they know this, and that's why Besant, our Treasury Secretary, is out there with some stealth moves toward kind of really supporting the bond market later in the year. But those moves are really kind of financial.
I love Thai tea. Thai tea so good.
Repression-like, which we can get.
You like Thai tea?
Well, what moves is Besant making?
Like the SLR expansion.
What moves Besant making? Punching Elon in the face, giving him a black eye. That's what moves Besant's making.
You've got then the whole thing with Wells Fargo.
SLR, which allows the banks to potentially buy more and spend more of their capital.
So it's almost like
treasuries, he's hoping.
Exactly. It's almost like QE. So we calculate that SLR expansion could be up to 250 billion of new buyers. So they're using the bank balance sheets almost like the Fed, right? The banks are going to be supporting the market. The question is, how fast does that 250 billion come in? Is it this year or next year or the year after? And that depends on the Bowman situation with the Fed, and then that debate between the regulator at the Fed, Bowman, and then Powell himself.
We know that yields have backed up a little bit, but then we also see good economic data, and that brings yields back down. Where inflation is not running higher, the economy's doing pretty well. What's to say that isn't the stronger part of this hand?
Yeah, that's true. Yeah, we've had a nice move down in like 3 CPI reports. Now, the probability that one of the next 2 CPI reports actually has some of the tariff pain in it, in other words, toward higher prices, I think is pretty high.
The first one coming this week.
Yeah. So so we're in a little bit of a complacent zone on inflation, which we think about the last 3 years, we've been there a couple times, right? We've gone from like inflation fears to kind of inflation complacency back and forth. So I think we're priced in. Yeah.
If the bill gets passed, if the economy continues to do well, if there is growth that's stronger, as a lot of the Republicans supporting this bill have suggested, then what?
Well, I heard, word on the street is, from what I heard, is the Trump administration's cooking the numbers in regards to the CPI. Cooking them even crazier than Biden was cooking those babies, okay? I don't know. I'm going to have to look into it. But from what I heard, they changed a bunch of things to make the numbers look a lot better than what they actually are. I don't know. I'm going to look into it, okay? Because there's always been said every government administration cooks the numbers essentially to try to make them look better than what they are in reality or whatever. And from what I heard, they're cooking them more than ever. But I need to look into that, so we'll see.
Thing is that Musk-Trump fight, and Musk outed kind of the fiscal largesse in the bill. If that bill, this is really fascinating for our viewers, if that bill gets delayed a month or so, then what's called the Treasury General Account gets drained more. In other words, that's the money in Treasury, extraordinary measures. And the reason why that's important for our viewers is that if that bill gets delayed and they can't merge the 2 bills by, say,
between the House and the Senate,
say it goes out another month, then all of a sudden you're burning through your extraordinary measures. That means the refill of that bill in the 3rd, 4th quarter is going to be a lot bigger, a lot more pressure on the bond market. That's what silver and platinum and palladium and Bitcoin, there's to us, when we talk about in the book, How to Listen to Markets Speak, we think $4 to $6 trillion is going to move from financial assets, which are just paper certificates, right? Stock certificates, bonds, over to hard assets.
Commodities, precious metals and other commodities.
Right.
And that's what you would advise people to do right now ahead of this?
Yeah, I mean, we think, the old 60-40 portfolio should maybe be 30, 30, 30, and 10. In other words, a much larger component of commodities.
30% commodities, 10% cash. Is that
Yeah,
what you're
10% cash, 30% bonds, 30% stocks.
What are the signs that we should watch to say that, okay, this move is afoot, aside from the moves that we've seen in silver and gold?
Agricultural names are dramatically outperforming. And typically they're second, third tier players. We saw this in the 2022 commodity bull market, so if you look at Mosaic and some of these ag players, now some people say, oh, that's the China trade deal getting priced into soybeans. Mm-hmm. But yeah, you want to look for the commodity market broadening out. And look at BCOM, Bloomberg Commodity Index versus the S&P, or Nasdaq, and look for those ratios.
Okay, how do I feel about his portfolio call there, right? Let me say a couple things. First off, where gold and silver and platinum and different commodities go in the short term, anybody's best guess. I have no strong opinion on where gold's going to be a month from now or 3 months from now or a year from now. Same thing with silver or anything like that, okay? Or platinum. But let me say this. Do I like his strategy? The answer is no. I like a strategy that has me owning things that produce cash, that produce more money. And as the years tick on, it produces you more money and more money. And I don't want to own assets, especially in any sort of meaningful way, where I just have to count on the next guy paying more for it, which is how gold works and silver and Bitcoin and all those things, right? You just got to hope the next guy is going to pay more than what you paid for it. So then I like things like stocks, like real estate, right? They have underlying an asset that then produces you money, right? Real estate, appreciation happens over time, obviously, but if you rent a property, you constantly have that cash flow coming in, right? When you own a great company, they make more money and more money and more money and more money year after year after year after year, right? They throw off more profits and more profits. And with those profits, they can do share buybacks, which means their earnings per share is going to increase even more substantially, especially if their net income goes higher, right? They can do dividends and pay you out dividends. They can go buy other companies with their profits, right? Which makes them even more profits and makes them even bigger and more powerful, right? Which means your investment's even more valuable. So there's a lot of different factors that can happen there that are very, very exciting versus just owning a commodity or something like that. Whether it's, once again, whether it's a Bitcoin or Ethereum or, gold, silver, platinum, whatever. I just got to count on hopefully that the next guy, pays more than what I paid for it, right? And so I like things that produce cash. That's stocks and that's real estate. And then anything else I'll own after stocks and real estate is 90% plus of my wealth outside businesses, right? And so outside of that, I own a little bit of silver. I own some collectibles, stuff like that. Small money. The big money, stocks, real estate. And it's going to remain like that. I don't see that ever changing in my lifetime, at least. That's just, until I'm in the dirt, that's the way it's going to be. And I have no problem with that. And, if some new crypto comes out in the next whatever years and, becomes the next big thing, that's cool. Doesn't mean anything for me in the end, right? I'm going to be doing just fine with my stocks and my real estate. And so, that's kind of my perspective on that. All right, next one up here. JPM recommends selling Tesla. Here's a breakdown of the call.
Of orders and deliveries. Let's start first off with orders. The most for a month since the Paris or the Farnborough Air Show last summer. A total of 300 planes were ordered last month. That includes 150 as part of the big announcement with President Trump a couple of weeks ago in the Middle East. Those were to Qatar Airways. They also logged 146 orders for the 737 MAX. Speaking of the MAX, production last month has been increasing. Total deliveries for the month were 45, but more importantly, the deliveries of the MAX up to 32 for the month of May. And they actually hit a build rate of 38 at the very end of the month. Now, if they can sustain that, if they are comfortable with the supply chain, at some point they could ask the FAA. They've already indicated they're planning on doing this, perhaps sometime in the next month or two. Ask the FAA if they can increase production to 42 per month. As you take a look at shares of Boeing, keep in mind that the Paris Air Show is next week. So we'll get more orders and announcements. I'm not sure we're going to get huge ones like we saw out of Qatar, But you never know when you go into Paris.
So I get asked about Boeing, a decent amount, and kind of my perspective on it. Obviously, the stock's immensely lower than it was, probably 6-7 years ago. My perspective on Boeing is the same as it's been for years. Every time that company starts to get momentum and it looks like, oh, they're actually pulling it around, here we go, they let you down. Every time, man. It never fails. Like, hopefully, maybe this time they don't screw it up and things go better for them and they just get it together there. But if you look at that company for the past 6-7 years, it's not like it's just been the last year. No. This has been a 6 to 7 year cycle with Boeing, where every time you can say things are going to look better, numbers are going to get better, it just gets worse. And something happens and it's like, oh my gosh. And so that's why Boeing just doesn't interest me. As a trade, I can see people maybe making money here and there in it, but it just seems like every time you start to get exciting, like things are turning around, boom, you get hit with something bad. It's crazy, man.
Meantime, Phil, we did get some reports this week that there were some fresh MAXs being, or at least landing in China. Is there a sense that those deliveries are getting more constructive with the trade backdrop?
Well, they did say that they expected for deliveries to resume. So to what extent, you know how this goes, Carl.
Is this Boeing?
They will deliver a few, and then, 3 or 4 weeks ago, the Chinese turned around and said, take them back. We're not taking delivery of these. That is 100% contingent upon what happens with trade negotiations between the United States and China.
Phil, appreciate that. Stay with us. We want to take a look at Tesla as well. Yesterday, it was Argus and Baird that cut to neutral over concerns about Musk's fraying relationship with the president. Today, it's J.P. Morgan. Their argument is to sell Tesla and buy auto parts suppliers. They argue that given the headwind from tariffs and some other regulatory changes, the impact will be much more benign for suppliers than for automakers. Wells does pile on a bit. They write that Tesla's on pace for another poor quarter on deliveries. Phil, despite the negative commentary, stock it's awfully hard to keep it down, certainly off of that 273 low the day of that feud.
They have a built-in core base of investors who are going to stick with Tesla regardless of what the delivery rate is, how much it slows down, especially in China and in Europe. When you look at all of this, Carl, at the end of the day, it comes down to Optimus and autonomous. And there are more than a few analysts who are saying, okay, cool. If that's the future, which Elon Musk told David Faber, it's Optimus and autonomous, how do you put a valuation on that? Are you going strictly on Elon Musk saying, exponential growth in autonomous or Optimus robots? And autonomous, we're going to be all over the place. You can't build anything off of that. That is 100%. I think Elon is right, and I believe in Elon, and that's where the support is coming from.
Yeah, so in regards to Tesla, is the stock a sell? Sure, it's does it make sense to sell Tesla if you own Tesla? The answer is absolutely. But with that being said, you might not get the timing right, because at the end of the day, the market's risk on right now. Look at the Russell. The Russell's up again today, right? You're in a complete risk on market. If the market's risk on, right, people want to take a risk. Tesla does very well in a risk-on market, right? So that makes it very difficult to get that stock down in the short term. As soon as the market starts to flip and you start to go risk-off, which, when is that? I don't know. We'll see. Maybe it's a month from now. Maybe it's this fall, right? When you start to get some fireworks and maybe we get a 2018 situation, you get a big drop in the market. Once that happens, that's when we can talk about the deterioration of Tesla stock, right? But for now, if the market's risk-on, it's insanely hard to get Tesla down in a risk-on market. It's just the bottom line. Same thing with something like a Palantir or even an NVIDIA. I mean, can you get stocks like Tesla and Palantir and NVIDIA down in a risk-on market? It's tough, really tough. Can you get those stocks down in a risk-off market? Oh my gosh, off a cliff. I mean, we watched that with Palantir. Palantir went from $40 to $6. I think it hit $5.98 in 2022. $5.98 from $40 at the peak back in 2021? We watched Tesla go down peak to trough about 70%, right? You watched NVIDIA go down peak to trough 50%. So market goes risk off all of a sudden, Tesla will fall 50+%. It will get destroyed. But you have to get the risk off part right. If you don't get that part right, you have to kind of be very timely. Like I had some puts on Tesla recently, made 40+% on those, cashed out and said, peace. because I was like, you know, at the end of the day, the market wants to go risk on right now. And if now I still had those puts on, I would now be down big on those puts. Instead of making 40+%, I would have taken a loss if I didn't take my profit and get out and say, peace, I'm good. 40% plus in like 2 days. Thank you. Bye. And so you have to kind of be, you know, if you're hedging your portfolio and you get a chance to make 40+% in a quick amount of time, you got to take your money and run. Unless you go into a risk-off market. Unless you're confident you're going to go into a risk-off market, but you got to get a bunch of confirmations about that. And you need bigger things to be going on out there. You need like unemployment to be picking up substantially, or inflation, or the bond market popping, or, you know, you need something that comes out of nowhere that's like big to really get a true risk-off market where all of a sudden the S&P 500 goes down 10 to 25% in a short amount of time, right? Then we'll be talking about Tesla. You know, if you talk about S&P 500 and Nasdaq goes down 10 to 25%, you'll be talking about a stock like Tesla goes down 30 to 50% in that sort of market. You talk about S&P 500 goes down more in that, you know, 25 to 40% range, you know, stock like Tesla will be down 50 to 80% in that sort of market. You know, you talk about S&P 500 go down 50%, like what happened in the GFC, Tesla will go down 90%. 90%. But what are the probabilities you're going to get a great financial crisis type market, right? And remember, that market took a long time to play out. You know, that market peaked, if I recall, summer 2007. The final lows weren't until, you know, February, March of 2009. So it's not like it all just went in one day. So if you think there's going to eventually be a 50% type drop in the market where, you know, in that market, Tesla falls 80, 90%, just understand it won't happen all overnight. It'll be a process that gets the stock there. Okay. So just all things to kind of factor in and keep in mind there, okay? If you're looking to take your investing up to a much higher level than where you're at, learn how to play this game regardless of what happens with the market, pin and comment down there, click on that, fill out a form, see if we get you access to inside my prep stock group maybe a little later on this week. Stop gambling money in the stock market, start being confident when you go in and make decisions, start understanding how to hedge portfolios properly, all those good things. You know, I teach you all that in the course curriculums, take your game up to a much higher level than where you're at right now. All right, guys, much love as always, and have a great day.